The important thing, Ari, is not to say one thing's right or one thing's wrong. To be investing or to do investing is better than no investing. One time I remember at Lehman Brothers, obviously back in the day, it was around bonus season. It was just a big, huge buzz. I went on the trading floor, knowing nothing really about investing, about finance, about investment banking. And I just remembered those talk about, people had all their Porsches. As a young, person looking at them, was like, wow, okay, this is great fun. I want to be involved in this. Are you investing to make money, or is it more to meet a longer term goal at a very high level? I don't think it's necessarily as important what you do as much as that you're doing something. People want to find that needle in the haystack. They want to be able to talk about an investment that they made that went up. Hopefully, find more of them to understand the investment you're making and the reason that you're making it. Dividend products, clearly will rise and fall with the market, but you're generating stream of cash flows from certain companies. Again, not to get sort of carried away, but there's almost no risk that's too big. You got to be patient and take a longer term view.
Investors, welcome back to another go-round of Masters of the Market. Now, this week, I am incredibly excited to have on with me Mr. Will Rhind. He's the founder and CEO of GraniteShares, a global investment management firm started back in 2017. But to present day, we're talking about assets under management of roughly $4 billion. But here to share the journey with us all is Will himself. So Will, first and foremost, thank you for joining me on Masters of the Market. And I want to toss the first question right over to you and just ask you how you got to where you are today and what's been your journey thus far.
Great. Well, Larry, thank you so much for having me on the show. Great to be with you today. In terms of my start or my journey, I'm probably more a traditional in the sense that I've always done asset management, with the exception of a brief stint in investment banking after I finished college or university. So I did investment banking for a couple of years, and then went into the asset management side, and honestly, just right place, right time. I got a job at what was then Barclays Global Investors, which now people will know as BlackRock. And we were launching the first ETFs in Europe. And so just from being there at that moment in time when this new product category was being created, and I had a front row seat to launching these new funds called exchange traded funds that clients, customers, investors were finding out about for the first time. And so from my front row seat, I could see that investors were really sort of enthused about this, and were definitely much more enthused about our ETFs than any other products that we had. And so back in the day, the industry was very small. Assets under management were very small. Not the trillions of dollars that we have now in terms of global ETFs. And really, I started there and then followed the product through my career. So I built, managed businesses in the space. After that, including obviously my own business, GraniteShares, which I'm sure we'll get into, in this conversation.
Well, I want to take a step back and even go into the personal direction a little bit and just ask you, what got you fired up about entering the financial industry? And even more so, what keeps you motivated today to continue to help others, get invested and share the knowledge, especially with ETFs? Because as we'll probably get into, ETFs are really something for everybody.
It's interesting because, my background, I suppose, if you'd had to think about what I might be doing, finance is probably not it. So I grew up in middle of nowhere in Scotland, and the closest town or the closest city to me was Aberdeen, which is on the northeast coast. And for people that don't know, Aberdeen is famous really for one thing. Apart from the city itself, the buildings are made out of granite, and that's in a way where the name of the company comes from. But apart from that, the main business is oil and gas. So we have the North Sea oil and gas fields that are off the coast of Scotland and sort of intersect between Scotland and Norway. And majority of the UK's oil and gas comes onshore in the northeast of Scotland around Aberdeen. So there's a big energy hub there. And obviously I say was because the industry is unfortunately declining, or has been in decline for the last few years. But It was Europe's oil capital and like the Houston or the Dallas, of Europe. And from that perspective, I always thought that I'd probably end up in the oil industry or the energy industry because, going to high school in Aberdeen, all of my friends' parents, pretty much, that's what they were involved in and the reason why they were all there. Asking me, back in the day, what I was most likely to do, it would almost certainly be finance, but sorry, excuse me, oil industry. But when I went to university, I went to university away from Aberdeen. I went to Bath, which was in the southwest of England. And Bath's a small town, very beautiful town. It's like a college town in sort of American speak, but there's no real industry there. So the university, the natural sort of place you go to get your first job, etc., is London. And London obviously is just such a huge, metropolis. It's the UK's capital, but it's bigger than that. It's one of the world's mega cities. So if you want to get a good paying job, good career industry, then you pretty much have to go to London. So when I was studying at university, my direction kind of changed because a lot of my friends were naturally looking for jobs or trying to get jobs in London. And so because the economy of London, at least at that time, we're talking about 2000, the early 2000s, was 100% pretty much dominated by finance. That clearly a lot of the jobs that people were looking at were financial jobs. So I kind of really honestly just fell into line and thought, okay, well, I'll try finance and apply for jobs. I was lucky enough that I had a cousin who worked at Lehman Brothers at the time, and so I'd go and stay with her in London. One time I remember she brought me onto the trading floor at Lehman Brothers. And, obviously back in the day, it was around bonus season. It was just a big, huge buzz. And so I went on the trading floor, knowing nothing really about investing, about finance, about investment banking. And I just remembered that, around bonus season, there's always talk about, people had all their Porsches that were ordered and sort of lined up outside, and, all these kind of crazy stories that as a young, person looking at them was like, wow, okay, this looks like great fun. I want to be involved in this. Really, from that moment, I focused on applying for jobs in finance and in banking. That was sort of my goal, and got my foot in the door with a graduate job at Nomura, which is the largest Japanese investment bank. So started there, and then, like I said, made my way into asset management.
Okay, now on a personal front, I'm curious to know. I mean, the firm now, GraniteShares, is really circulated around ETFs, but I want to dive into this notion of what's better here for the average Joe investor to invest into. Do we go individual stocks? Do we go ETFs? I mean, when you invest on a personal front, are you more weighted in ETFs or individual stocks?
So I'm 100% in ETFs personally. And again, that's not a bias thing just because I have an ETF business. It's more that, we'll get into this, like for managing my personal money, clearly I have all of my, time, effort, blood, sweat, tears, etc., tied up in GraniteShares. So that's my major risk trade. Have all of my sort of, my effort, my equity capital, etc. So anything I do in the market is sort of largely conservative. And I don't want to worry about it or don't think about it. So I have equity ETFs, which I invest in, and they just sit there and generate those compound returns for me. Obviously as the market goes up, but I do that just purely for simplicity's sake, because my focus, my major sort of wealth building engine, if you want, is the business, and that's what I'm focused on full time. But I think the important thing, Ari, is not to say one thing's right or one thing's wrong. In other words, people shouldn't buy individual stocks or people shouldn't buy ETFs. In my mind, it's kind of this conversation which you'll hear from me probably a bunch during this, is that to be investing or to do investing is better than no investing. So to start is better than not to start. And so if by getting started, that means you're buying individual stocks, I have no problem with that, or buying ETFs. I mean, it's just, to me, the important point is being invested and learning to become a practitioner and, learning the ways of the market, trying to understand, if it's stocks, buy a stock that you love for whatever reason. Maybe you love their product. Maybe you have had a look at the financials and think that there's, good growth prospects, whatever it may be. But I think the important point is, to be invested rather than not be invested.
Let me ask you this. A lot of investors, especially us average Joes, if you will, right, who are not working in the financial world
Yeah.
As our day to day, but yet we want to get invested in the market. There's always typically this element of fear. The fear comes in and tends to creep in for newer investors when it comes to just getting started. And the fear creeps in for more experienced investors, perhaps in the fear of missing out of an investment opportunity. How do we navigate through fear?
I guess it's one of the core sort of elements of behavioral finance, and ultimately, a lot of very famous investors will tell you that this is one of the most important disciplines to have in terms of being able to manage your emotions vis-a-vis market moves. So to me, like I said, I think that there are different things on the risk spectrum which people should be aware of. So investing in fixed income is less risky, all things being equal, than investing in equities. And investing in a broad market index, something like the S&P 500, is less risky than investing in an individual stock. And obviously, the smaller that stock goes, then all things being equal, the more risky that stock is. So again, I think depending on where you're kind of getting started, but if you're getting started, let's say just invest a no regret sum of money. It could be as little as $100. I mean, now there's so many ways for you to access the market, like incredibly cheaply. Ways where you had to have a minimum account size of 250,000, a financial advisor that was, charging you huge commissions and, probably putting you into all sorts of inappropriate products. That you can buy either access to individual stocks or ETFs, or you can buy a curated portfolio from a lot of these online robo-advisors or wealth management services very easily and very cheaply. So I think start with a no regret amount of money that clearly you're not going to lose sleep over, and you don't have to worry about too much. And I think that starts the discipline or the training of being able to almost like ignore it and say, you know what, the time in investing is the most important thing, the time horizon. So we know that if you invest in the stock market, then almost doesn't matter when you buy, that over time, the market will be higher. And that's a function of growth, that's a function of inflation. And that is just the way that our market economy works. The only sort of caveat to that is clearly the time horizon that you're invested in. So I think for anybody, especially people on the younger side, that clearly there's almost, again, not to get sort of carried away, but there's almost no risk that's too big in the sense of investing in the market, because you can afford to wait it out. You can afford the time horizon, because we know that if your time horizon is 5 years time or 10 years time, the market almost certainly is going to be higher than it is today. And so therefore, I think that's the perspective that you need to have. And it's that ability to say, okay, in 5, 10 years time, 20 years time, 30 years time, the longer you go, clearly the more confidence that you'll have in terms of that being the right decision. And, it's really just, I think to avoid, on those down days, constantly looking at your portfolio and sort of mark to market moves and saying, oh my goodness, I've lost X amount today or this week or this month, and knowing that, okay, it's okay, that's how it works, but you got to be patient and, take a longer term view.
Sure. More of that Warren Buffett like approach, if you will. Now, let's say someone overcomes that fear. They have this lump sum of money, maybe it's 5 grand, 10 grand on the sidelines. They're ready to invest. I'm curious to know from your standpoint, with all your experience, what should someone's process be, or what's your process really in how to go about picking stocks? Because we're always trying to find the winners, right? The needles in the haystack. But what is that game really like, and what's a good process to have in place?
Yeah, I mean, this is, again, there's the $1 million question, because it's so different for everybody, and that's what makes the market. That's why that for every buyer there's a seller. And some people love the fundamentals of it and really can get into the weeds of earning statements and trying to figure out with their discounted cash flow models what the fair value of a company might be. So the real sort of Warren Buffett or Benjamin Graham type approach. And then there are others who don't care about that whatsoever and look at technical analysis, which is really study of charting and looking at the way that a stock appears on a chart, and can say, okay, this stock is going to go up or the stock is going to go down from that. And there's 1,000 other ways sort of in between. I think again it comes back to like what are you comfortable about? And I think for me that starts with being able to understand the investment you're making and the reason that you're making it. So whether it's an individual stock or whether it's a broad index, whether it's whatever type of investment, I think it's about understanding it and therefore understanding what are the drivers of that stock price or that ETF. So do you understand that, if XYZ happens, that's going to be good for the company, or XYZ happens, it's going to be bad for the company? And I think from there, to me, that the important thing is then that's your frame of reference in terms of your knowledge, your understanding of how things move. And then it's about, clearly just the time horizon, in order to sort of manifest where that goes.
Now, I had someone on relatively recently who worked at Amazon, and one thing that he really harped on was management, really needing to get a feel for management. Now, this is always an interesting question, right? Because I think as an investor, right, I want to look to companies that have great standout leadership teams, good quality management teams. But as the retail investor, I have no way of really picking up a phone and making a phone call and getting to know the ins and outs of really the leadership. However, someone in your position very well may have that opportunity. I'm curious to know from your standpoint, is understanding management teams, on the retail investor side important? What are things we should look for if it is important, or is it not as important as we think?
So I don't think it's important at all. And the only sort of circumstances I can think of where it is important is, and maybe it's the only thing that's important, is the closer you get to a startup. So the extreme example would be if you invest in a startup where they're looking for seed money, so it's the first money, friends and family round or something, the only thing you're investing in is the management. And therefore the only driver of success and failure is going to be the management. Now, contrast that to, say, one of the biggest companies in the market. So you pick it, an NVIDIA, a Microsoft, an Apple. The market is already kind of pricing in the management. And, from that perspective, even, these companies are so huge that even things like buybacks or directors, insiders selling or buying doesn't really matter that much. But I think the market is already framed how it thinks about the management of that company. And therefore, I can't really think of a good example where, the management, is something that people should really focus on from a large cap company. And again, to your point, right? I mean, how would you really evaluate that? You can't. As a retail investor, you can't. The only thing you can do is probably look at something like the tenure of the CEO, because sometimes if it's a company that, hires and fires its CEO, that's problematic. But again, this probably already reflected in the share price. You probably will have a stock price that's going up and down, or is heading in the wrong way. And then it's buybacks, and is the management buying back their shares? But again, it's less relevant, the bigger you get. So to me, it's interesting, but for the average sort of company, I think that a retail investor would be investing in, probably I wouldn't pay too much attention to it.
Well, let's talk about not putting all of our eggs in one basket, or perhaps we can put an egg in an ETF basket where we can get, right, a plethora of holdings just by a single share. So this is your forte with ETFs. First of all, I want to know, ETFs may be considerably dull for some investors, right? Something passive you could put money into. You don't really lose too much sleep when you invest into an ETF. And if you do, perhaps you're really, not meant to be an investor, but you really want to stay steady on that gun. And so investing into ETFs, why ETFs in the first place? I mean, let's take like a Pershing Square, right? That seems like a fun job to be, Mr. Bill Ackman versus, Will Rhind, who's, overseeing ETFs. What is it about ETFs that is a driver for you and is a fascinating key point for all of us to perhaps start looking more into ETFs and just individual stocks?
It's really interesting. So, the analogy perhaps I'll use is that an ETF or running an ETF business is like running a supermarket. And what Bill Ackman's doing is running a high-end boutique. And so they're just two different expressions of the same thing, which is we're both selling something, both selling goods, but we are selling, at a high number of products at a low cost. He's selling one or two products at a high cost. And that's ultimately the simplest sort of, definition or, thing that sets us apart. But apart from that, we're still managing money, we're still launching investment strategies. And it's really a question of what kind of investment strategy you're looking for. So ETFs, one point to make is that the ETF is just like an app, right, on your iPhone. That an ETF is just a wrapper for whatever investment strategy is contained within that ETF. So you can have an ETF on the most boring things like treasury bonds, and you can have an ETF like some of the stuff we do, which is incredibly racy, on things like 2x Nvidia, 2x Tesla, etc. in our stable, and everything in between. So the ETF thing is more like, oh, there's an ETF for that, just like there's an app for that. And really, the ETF is just the modern technology of the mutual fund. So the mutual fund was the only way to invest really with pooled investment vehicles, up until probably, let's say, when the ETF started going, which was, going on 25 years ago. And slowly but surely, the ETF is just replacing that old technology. So mutual funds having net outflows as people realize they're too costly, too clunky, not enough choice, tax inefficient, the list goes on. And the ETF is just the new technology. So outside of the flavors, it's within that new technology. It's the ETF is really just an expression of almost whatever investment strategy you want, whether you want to invest in commodities, in currencies, in bonds and equities. It's you have an ETF for everything pretty much. And so therefore, just like single stocks, where obviously every company is different, every ETF is different. And you can choose really an ETF that fits your investment needs, from the very conservative ETFs to the really sort of sexy, racy ETFs.
Sure. Now, just like there's ETFs for everybody, I feel like there's firms for everybody. So you yourself overseeing GraniteShares, but how do we retail investors go about even picking the right firm to run with, right? I mean, you were at iShares previously. Vanguard for me is a top dog, but there's firms to pick from. And for some of us, it could be a little bit perhaps perplexing, understanding the differences. I mean, are there certain things we should look at when we go to pick an ETF, like just more than the stocks and the ETFs?
Definitely. And I think then you're sort of getting into a really good area of discussion, which is, is it the firm that you're kind of picking, or is it the product? And, for me, what we try and do is we try and focus on products which are more high conviction. So high conviction products for high conviction investors. And the differentiation between us and, say, the Vanguards and the iShares and things of the world is those, again, to use the supermarket analogy, those are like the Walmarts of the world that offer a lot of different products at a very low cost, but they're a certain type of product. Whereas we are much more, in this case, like the Bill Ackman example, we are much more like the boutique that offers very specific things which they don't offer. So in our case, we offer leveraged single stocks as one line of product. Leveraged single stocks is something that none of those firms offer. So you cannot buy that from a Vanguard or an iShares, etc. You have to buy it from GraniteShares. We offer things like commodities. So again, some of them offer, but Vanguard doesn't offer any commodity ETFs. So you cannot buy that from them. And that then goes into the sort of entrepreneurial side, or the entrepreneurial discussion around GraniteShares and what makes us differentiated. But simply put, Ari, we have to offer things that are different. We have to offer things that add value to investors. and solve problems for investors. Because if we just offer the same as the big shops, we're going to get killed, and we don't want to get killed. So we are trying to offer things that, are genuine innovations in the market. So we really pioneered, leveraged single stock ETFs that didn't exist about a year and a half ago. We started that in Europe. It's a successful business for us. We brought it to the States. We have to innovate, just like any company that is growing, in a space that's dominated by large incumbents. You have to provide value to investors. And so a company like GraniteShares is going to offer unique products that you can't buy, for the most part, anywhere else.
One of the products I know that you have are some of these higher income ETFs. Now, I run a dividend investment channel, and I have growth stocks in my portfolio, but dividends are big for a lot of investors.
Yes.
Becoming an income investor. Can you talk about some of your income ETFs and the benefits of running with an income ETF versus trying to pick dividend stocks that are going to be your winners over the long course of time?
So the first thing I'll say is the reason why we have any kind of ETF that's typically diversified is that they run on an index. And an index, think of an index as like your rules of engagement or your roadmap for the investment strategy. And simply put, the idea here is that it takes away the need for the investor to buy or to make a bet on an individual company, and whether that's the right company or the wrong company. So what we do with something like HIPS, which is our flagship income strategy, and that stands for high income pass-through securities, is again, that's a unique area of the US market where you have this class of security called a pass-through security. And what that means is those securities do not pay corporation tax. They have a special treatment whereby any income that they generate, they have to, by law, distribute almost all of that to investors. So in the case of HIPS, what is a pass-through security? There are four major categories, and those categories are REITs, which most people probably know about. So that's real estate investment trusts. And they're typically, securities that own physical buildings, or they could be mortgages. But there are two types of REITs. And then there are MLPs. MLPs are master limited partnerships. And they're, again, securities that own energy infrastructure, so typically oil, gas, pipelines, things like that. And then you have business development companies, or BDCs, and they're entities that own they're almost like private equity, firms for middle market companies, so lending money, etc., to mid-market companies. And then you have closed-end funds, which are a class of fund that have different strategies. Typically, they're oriented on the fixed income side that provide exposure to different fixed income strategies. And so those blended together, in the case of HIPS, it's an equally weighted portfolio. So you have a 60 stock portfolio, 15 stocks or 15 securities in each sector, and we distribute that income on a monthly basis. Now, what's cool about that is that it's a fixed cash distribution. So that means that every month you get exactly the same amount of cash from the fund, so 10.75 cents per share or $1.29 of income per annum. And the reason why that's interesting is because when you buy it, you're locking in to that yield, depending on when you buy. So right now it's 10+% yield per annum. And so that's really attractive, especially if you think interest rates are about to go down. And we could be, if you're sitting in your money market fund or your, treasury bond fund, whatever it may be, and you're sitting on 5% and thinking, this is great. That if that 5% turned into 3% at the end of the year, maybe not so great. Whereas what we're trying to say to people with HIPS is, there's an opportunity to buy HIPS, lock into that yield. So if interest rates drop, then that you'll be sitting pretty in that fund. That's kind of a way that we approach it. Again, trying to do something unique, something different that doesn't exist elsewhere. So you don't have to get involved in which MLP do I pick or which BDC do I pick. We select those via the index. So trying to select securities that have the highest yield but the lowest volatility within those particular sectors.
A lot of investors get caught up in yield. I can't say how many times I've seen this debate, if you will, across YouTube, across different social medias, right? But is it better to go with high yields lower yields? Because a lot of the times what we see happen, take like a JEPI, right? Like comes out of the chute, it's strong, but now over time we're seeing depreciation in the actual share price. But yet this dividend yield, okay, it's sexy, it's a great looking yield, but you're losing money regardless. Is there safety in this product now that you have?
So the first thing I'll say, and that's a really good point, is what are you buying the dividend or the income product for? Are you trying to generate income through effectively capital gains, or do you need income for the sake of income? And I say that to make the distinction between a lot of dividend products that, the dividend products, clearly will rise and fall with the market, but, you're generating a stream of cash flows from certain companies. And a lot of people will say, okay, well, I won't worry about income per se. I'll just buy, the S&P or whatever it may be. And if I need to generate income, I'll sell some of my S&P. And that's problematic because then you expose yourself to market timing. And so invariably, if the market's going up, that might be fine. But if the market goes down, and then obviously you're a seller on the way down, then yes, you're generating cash, but you're also generating big losses, which for income investors is not the way to do it. So a lot of times it's about what's the right fund for you. So HIPS, it's a monthly cash distribution, fixed distribution. So it would be for somebody that values the certainty of those cash flows every month. So if you have, a mortgage to pay, if you've got, liabilities like most people certainly in retirement have that they need to cover every month, there's a certain sleep at night factor by locking into that particular income amount and knowing that you're generating enough income to cover. And the portfolio, whether it goes up and down according to the market, doesn't matter so much because you've locked in those cash flows. But again, to come back, that is the risk paradigm when it comes to income investing is typically there's no free lunch, unfortunately, in this world. That the lower the risk that you take, the less yield you generate, and the more risk you take, the higher the yield that you generate. And just one thing that we don't use any options. That's just pure income. It's just buying these stocks, and the strategy generates income from those underlying securities. Whereas the JEPI, the JEPI ETF that you talked about, the way that generates income is primarily through options. And again, what people need to understand with options is that when you're selling options, that you're generating the income, which is going to be distributed to the investor. But by doing that, you're exposing yourself to the volatility curve. So in a high volatile market environment, you might generate a good amount of yield, but if in a low volatility environment, you won't generate yield. And also you're selling away a bit of your upside. And given the market has gone up, that yield is not going to be as attractive. So it's just things like every fund has its pros and cons, but it's just things to think about, when you look at these investments. And again, trying to understand how does a strategy make money? What are the pros and the cons? What happens if the market does this? What happens if the market does that? And then figure out, what you're comfortable with.
A lot of people jump right into the market, and graduate from what I always like to say, the University of Hard Knocks, right? So I've been fortunate enough to go and attend university, you yourself as well. But a lot of people out there either go to college, right, but they don't go into business or they don't go into finance, and they jump into the market and they learn a lot of their lessons by trial and error. And I'm curious to know from your standpoint, right, starting off investing, what is the best approach to get started, to get in the market? I mean, it sounds so simple, right? Time in the market is better than trying to time the market, so get in. But this is always a question everybody has, like, well, where the heck do I start?
Yeah, it's a really good question. And I think the part of the answer is what are you trying to achieve? And I think there's almost two types of investing, if I can say that. And again, I'm oversimplifying this, but the two types would be: are you investing to make money? In other words, to try and outperform the market and generate, is it a tool for generating a lot of money? Or is it more to meet a longer term, investment goal. And those are two different things, because one is long term and one is more short term. There's almost, I think, nowadays so many good tools for the longer term investor that it's very difficult almost to go wrong, in the sense that you can buy even something, like I said, something as simple as the S&P, the NASDAQ, whatever you're comfortable with. And even if you just own that, I know this is something that Warren Buffett said, many, many times, but even just doing that and keeping your time horizon is better than doing nothing. And that's a perfectly viable investment strategy over the long run. And then it's just about how much do you want to complicate it by putting other countries in, or other parts of the world, or some fixed income exposure. But if you go to robo-advisor, or most now digital brokerages, they probably offer some kind of investment plan, which is effectively just a diversified portfolio of ETFs almost always, that you can buy and invest in every month. So again, that's a very easy way to do it, but it's longer term. I think the challenge is for the investor that wants to make money. That's when you're going to have a lot of the school of hard knocks, and really try and figure out what parts of what stocks, what ETFs and things you're comfortable with, because when you're trying to make money on the short term, clearly that's going to be more risky if it's just you're looking for returns and outsized returns, and therefore you're going into leveraged funds, you're going into maybe options, maybe it's just stocks themselves. And in that way, I'm not sure there's a right or wrong answer. It's more get involved in doing something, but make sure you understand what you're doing and are comfortable with the risk you're taking.
A question that I typically get, whether it's via email, in the comments, is it too late for me? Now, a lot of viewers that I have are actually 40s, 50s, almost pumping retirement. And I mean, right off the bat, when you're talking about some of these GraniteShares, right, the HIPS ETFs, it sounds ideal, right? Because you can lock in. And I'm thinking now, well, what recommendations would you give to some of these elder investors who perhaps, as decades slipped by them, they didn't get invested? Is it too late for them? And what do they do?
Well, it's never too late. But again, it depends on what is your investment objective, because that is the defining thing in terms of the amount of risk you should be taking, and that therefore then bleeds into what kind of strategy you should be doing. So clearly, if you're retired, then you will have a certain amount of needs in your life that need to be funded, and maybe you have some excess capital left over. Hopefully, you do if it's about investing. But that strategy would be very different from someone who's in their 20s that should be just risk on, trying to soak up as much as possible because they have the time horizon available. Whereas what you don't want to do is be in your retirement age, take a huge amount of risk, and then time the market poorly, end up losing that capital or losing a vast majority of it, and then not having that sort of time to build it back.
Can I ask you, what do you think the biggest mistakes that investors are making?
They're probably the same mistakes that investors have been making for decades. And those are, first of all, not being invested, and then worrying or waking up at age 60 and realizing that you don't have a retirement nest egg, that don't have the capital to support your retirement or your financial goals for end of life. So not being invested is definitely one of them. And then being invested, I think it's probably chasing a lot of return sort of unnecessarily, and parts of the market that sort of notoriously difficult, like smaller cap stocks, or even smaller than that, been notoriously difficult for people to kind of time, and for any kind of investment edge to be had in that. So a lot of penny stocks, small cap stocks, things like that can be difficult. This sort of idea of a friend told me to buy this company, and this company has X amount of prospects, etc. You hear those time and time again. And then I think it's that what you were saying regarding, is it too late? A function of that, I think, is fear driven by market timing. So looking at the market, and as we're speaking today, it's a good sort of time because the market, the US market at least is at all-time highs again. And so you might be thinking as an investor, God, should I be buying at an all-time high? It's not a smart thing to do. And yes, in probably that is probably correct. However, the massive caveat again is the time horizon, and how long do you want to wait for the market to correct? And if it doesn't correct, then what do you do then? And I think dollar cost averaging, which is effectively just investing a consistent amount rather than maybe one lump sum and picking a time or picking a point and saying, I'm going in here, is to maybe split that up into sort of monthly investments, weekly investments, whatever you're most comfortable with, and try and average into the market. So if it goes down and then goes up, you get in a better price. Or if it just continues to go up, then you also get in, but at a weighted price. So there are all sorts of things that I think investors should be aware of. And of course, another one is just have a basic understanding of what you're buying. Always understand the investment, whether it's a product or stock that you're buying. Make sure you read up how it works and really understand that.
It's interesting. So when I have, fellow retail investors on, they always talk about trying to find the needles in the haystack. And then I'll have, professional in the field come on and they'll actually share, no, I'm invested in ETFs. and I'll give a perfect example, right? My uncle actually worked at Fidelity for about 25 years and managed a large fund there, just north of 25 billion. And when I asked him flat out, right, what do you invest in? Well, ETFs, fixed income, actually. and so I'm seeing this very safe approach to investing with professionals. And yet then there's the masses of all of us that I feel like are trying to pick the needles in the haystack. Is that the allure of us being sold? And, kind of the insights and the knowledge that I want to say those on the street have, that it's like, well, that's almost a loser's game. Go with the safest way. What's your take on all that?
You're probably right, but I think a big part that is always missed in that dialogue, because it's easy to say because we're in the market all the time. So, for us, investing in ETFs or whatever is super easy, straightforward, don't even think about it. I don't personally have the time to research a lot of individual stocks and sort of get involved in that, like I said, because I'm focused on running the business and doing everything that we do here. But I'll say in defense of those who do that, it's typically like that's their passion. They find that really exciting, and that's what they love. They would probably not love or would find zero passion, zero love with investing in a sort of boring longer term ETF portfolio. And or maybe that is the core. Maybe that's the core of the wealth, but they have a satellite portfolio where they use that to have some fun. There's nothing wrong with that. But I think that a lot of that is driven by that's what excites people. And people want to find that needle in the haystack. They want to be able to talk about the investment that they made that went up, beyond their expectations, whatever it may be, and hopefully, find more of them. A lot of investing at the end of the day is fun and should be fun. But for a lot of people, like that's what excites them. It's that sort of feeling of finding something that's undervalued by the market, and whether it's an ETF or whether it's a stock, being right about something. Buying into Nvidia beginning of last year, for example, all these things that people will buy and ride it up. And that feeling of saying, hey, I did the right thing, and try and repeat it. It can be very, I think, very satisfying for people.
Sure, it's certainly a thrill. It's almost like Vegas. It reminds me. I'm blanking on who said it, but he said if you're having fun investing, you're probably doing it wrong. And then you see a lot of, again, the massive investors. We're all having fun, and you get these then brokerages like, let's take Robinhood or Public, and a lot of these brokerages now that are flashing the lights to buy and to sell, or not to sell, but to buy. And every time you buy, the balloons go up and the confetti shoots out. how do we train ourselves to just be, a little bit more calmer on the execution of our trades and to take a breath? Does that come with experience, or can some of us at the get-go have that calm and ease?
It definitely comes with experience, but again, it comes down to what you're trying to do. If you're just trading for fun, then probably you're doing that all day. Looking at your screen, watching every tick. But for longer term investors, it's really, it doesn't matter. It's once you're in there, you just hold, and don't really need to do much else about it. So I think it just comes with experience, comes with kind of the comfort of understanding what markets do and knowing that, yeah, they're going to be drawdowns, and that's largely unpredictable. But if you're willing to ride it out, it's no different to buying a house and having your mortgage and knowing that there'll be periods of time when the economy will be bad and the theoretical mark to market value of your house will be a lot lower. But as long as you're not a forced seller and have to realize that loss when the market's down, you don't think about it. You don't think about every day, what's the value of my home?
Sure.
It's just hopefully over the time, by the time you come to sell it, you'll sell it for more than you bought it.
One of my favorites, John Bogle, had shared that it's best to get yourself invested into a broad market index fund as opposed to, some of these more specified indexes. Now, from your experience, is there truth behind that? Because I mean, today, as you share, I mean, we have option specific ETFs that are out there. We have just semiconductors, right? If it's hot today, right now, there's an ETF for it. And again,
Yeah.
this older traditional, right, insight of Mr. Bogle himself saying, just go broad market, like you can't lose. What are
Yeah.
your insights there?
Well, again, I think that's very sort of intuitive advice and makes a ton of sense especially for people that don't know investing. It's an easy application, right? To say if you've never done investing before, just buy an S&P 500 ETF and forget about it. That's the simplest sort of thing you can say to people. And so I think for people that don't know investing, new to investing for the first time, it's probably I'm not sure if there's a better place almost to get started than something like that. And obviously it would probably depend on where you are in the world. So it might be your own local index, if you're in the UK or if you're in France or whatever. So that makes a ton of sense. It's really just once you understand that, okay, that's a market return, and you can either do better than the market or you can do worse than the market. Then when you start to invest around and start to say, hang on, I can do better than this. Or I have a conviction around this, that, or the other. That's when you start to develop it. But certainly for people that are new to investing, or even people that are actually very experienced in investing, but just want to be able to sleep at night and don't want to, have any sort of surprises, investing in a broad index is 100% a sensible thing to do.
I want to zoom out with this next question, put you on the hot seat for a hot second. When you look back at your investment career thus far, what has personally been one of your biggest, mistakes or pitfalls that you've had a major turnaround from and learned a great lesson from?
Oh, I mean, so many. I mean, fortunately, none of them have been fatal. But I think when I probably the thing I think about most is in the first sort of startup I got involved in. So I was an equity holder in the business, and I was not the founder, but I was an equity holder in the business. It was a fantastic sort of learning curve in terms of really finding out about equity, in a private company and how that worked, and the rights that were associated, and obviously going in, the mistake I made is I was completely naive to all of that, and so had equity in the business but didn't really understand what that meant or how it worked, or what the rights were or weren't. And so, very long story short, is that became a very sort of protracted process, of which ended up, it's still being a good outcome for me, but there was a huge amount of lessons learned along the way that I'll never get myself into that situation again. And come out of that learning from your mistakes, knowing that, okay, even if it was a mistake, that I still learned a ton, and I'll just make sure that I don't make that mistake again. And I think that's probably one of them that springs to mind. But there are so many others. The key thing is just to learn something from it, move on, and get better over time.
Not to dwell on the mistakes. Let's talk
Absolutely.
GraniteShares premiums. And oftentimes with an ETF, there's these premiums that we like to call fees. And I want to know from your perspective, are the fees worth it? Because again, like you go with, I don't know, like a VTI, right? And the fee that's tacked on there is almost nominal. And some of these other fees you'll see, upwards of 1+%, which doesn't sound like a lot, but over the course of time, as we know, it does sum up to a hefty amount. What's your take on fees? What is GraniteShares doing to really level the playing field for retail investors to come over to GraniteShares?
So fees are 100% commensurate with the strategy that's being run. So the simpler the strategy, the less expensive it is. So again, think about it from a manufacturer's perspective. And let's say we're a manufacturer, Vanguard's a manufacturer. Something that costs me, or the lower cost, or the lowest cost thing for me to manufacture, I can sell at the lowest price. Something that costs me a lot to manufacture, I have to sell it at a higher price. So your bog standard VTIs, your equity portfolios, that's just a collection of stocks, and specifically, large cap stocks or US market stocks, those are very, very cheap to manufacture. And so you can sell those, and the strategy around it is volume and price. So again, going back to the supermarket analogy, high volume, low price. And that's fine. The strategies that we do, we have something like gold, for example, which is the lowest cost fund that we do. So that's at 17 basis points, and that's physical gold that sits in a vault. It tracks the price of physical gold. That's actually relatively inexpensive exposure for us to deliver, even though you might think, well, physical gold bars and things, that sounds like it is expensive, but it's largely an operational fund whereby for us delivering that exposure, we can do that very inexpensively. But we also have the comfort of knowing that's a big market. So just like a VTI or an SPY, they're managing hundreds of billions in some cases at that price. So revenue-wise, it's extraordinarily lucrative, but you've got to think about the assets that are being managed. Whereas for our gold fund, we're managing around about $1 billion at that low cost. It's still a good fund for us, but it's not, 100 billion at that price. And then contrast that to some of our leveraged single stocks, where we charge 99 basis points, which on the surface of it is like, oh, that's really high, but that's a really complicated product to put together. So therefore the cost is higher, plus you have leverage. So the return expectation is a lot higher. So if you were in NVIDIA, 2x NVIDIA last year, and you made, a few 100% from our product, would you think it was unreasonable that we charged you less than 1%? Hopefully people would say, no, not at all.
Sure.
But the other thing that goes with it is, again, that's a smaller market cap type opportunity. So we're not expecting these funds to be hundreds of billions in size. We're not even expecting them largely to be $1 billion plus in size. And so therefore we have to price them appropriately. So they have to be more expensive because the costs are higher, and the revenue sort of market opportunity that we have is lower than the likes of a broad market fund. We can, sell it cheap. Our broad commodities one, that's the cheapest fund you can get in the US market for commodities. That's COMB is the ticker. Broad commodity futures. Again, it's a very scalable fund. So doesn't cost us a huge amount of money to run it. And because it's futures backed, it's very scalable. So we could have, hundreds of millions of dollars in that fund. And, the cost to us to run doesn't make much of a difference. So we have very low cost products. We have high cost products, but everything is priced appropriately. I don't think in the ETF world, you can get away with, fees that are really higher than 1%, unless, again, you're doing something that you can't buy anywhere else. So it wasn't an ETF, but the Bitcoin Bitcoin Trust GBTC was it was a slightly odd vehicle, but it traded more like a private fund. But for anybody on the secondary market, that was for a while the only way they could get exposure to Bitcoin in a exchange traded vehicle. And so they were charging 2%, and people were happy to pay that 2% because it was the only way to get exposure. Now there are alternatives. The price is coming down or has gone to zero in many cases, and that sort of game is over.
I will admit that I actually was invested in GBTC because that was the only investment vehicle for me that I'd want to get
There you
into
go. Yeah.
the Bitcoin. I'm curious to know, so GraniteShares, we have a lot of the big dogs that are out there, right? Again, JP Morgan funds, then we have iShares, Vanguard, right? They're all over. When it comes to GraniteShares, what are some of your most popular products that you have seen a tremendous amount of momentum with, that if I were to jump over to GraniteShares right now, it would lock me in?
So the most popular products are on one side of the spectrum, our gold ETF, BAR, so just physical gold that tracks the price of gold. It's very popular, especially now, with gold being at highs again. And then on the other side of the spectrum are the category of the leveraged single stock ETFs is very popular with people because if you love Microsoft, you're going to love 2x Microsoft, or Tesla 2x Tesla. But Nvidia has been the biggest one. So 2x Nvidia, which is our NVDL, that's a kind of global superstar fund now, because the price of Nvidia has done so well. So 2x Nvidia has done tremendously. That's been the one right now. Also our Coinbase, 2x Coinbase one has been very popular because the two biggest trends in the market this year have been AI and crypto. So sure. If it switches back to EVs, then Tesla, I'm sure, will be amazingly popular again. Or if it switches to China comes back online, it'll be Alibaba, and so on and so forth. But I think for that, for the more active investor, the trader out there that has a high conviction view on those stocks, these levered stocks have been very popular.
Let's talk macros for a second. You mentioned Tesla, which, by the way, might be an opportunity to go into a lot of these not so trendy stocks at this point in time, but are still players in the game. Macro wise, I mean, just the other week we had CPI come in much hotter than expected. And then, this past, the other day, we had Jerome Powell come out and share that they were holding on interest rates, rate cuts to come later on this year. How much should us retail investors pay attention to macros, if at all? How do you use macros in your everyday to get a good gauge on where to invest and how to invest?
I think people should pay attention to it. I think it's probably the most important thing outside of, just your time horizon and being able to stomach, whatever the macro throws at you. So certainly something that I pay attention to very closely. And, the good news is that right now things are looking pretty good. And, well, especially if you're sitting in the US, I should caveat that by saying that the US market, at all-time highs, with the Fed's March meeting minutes coming out and the press conference saying that they expect to do 3 rate cuts still this year at some point, maybe starting in June. Inflation coming down. It looks like GDP growth obviously there, and then throw in an election year to sort of add another catalyst there. And I know you say that because again, statistically speaking, that the market goes up in the year that there's an election and also in the year following election. So statistically speaking, if history is any guide, then this year will be a positive year and the next. So I do very much look at the macro situation and very much keep an eye on what's going on to make sure that there's no sort of brewing signs of trouble in the economy or some obvious areas which could direct us the other way, which is down.
I have 2 more questions for you. This next question I want to ask because of the wild amount of success that you've actually seen, and especially with your firm just getting assets under management of $4 billion. Congratulations there, by the way.
Thank you.
What I want to ask here is if you just had to give one piece of advice to all of us retail investors here, just one piece of advice to leave us with, what piece of advice would that be?
The piece of advice I'd give is really, when it comes to investing, it's better to be investing than not investing. So I think, we can, and when we've talked about a lot of it, but we can talk for hours about the different strategies, different things. And I think it's probably important just to say that at a very high level, I don't think it's necessarily as important what you do as much as that you're doing something. And so, just to get invested.
Now, this next question, the last question here for you, it's my favorite question to ask every master who comes on to the show. Now, this one I think will be quite interesting given your position. But if I were to gift you with, which now seems minuscule to the 4 billion in assets under management, just a lump sum of $10,000 to invest into a individual stock or an ETF, I'd be curious to know which ETF or stock you would invest into and why.
So I'll deliberately not say any of my own funds in case people accuse me of rampant bias. So I would say, honestly, if it was just $10,000 to invest in the market, I would go for either the S&P or the NASDAQ. So one of those, it doesn't matter really what ETF you pick. Any ETFs on there are all very similar in terms of price and exposure. But one of those two indices, if you're more tech orientated or are comfortable with a higher volatility, I'd go for the NASDAQ. And if you just want broad market exposure to the US, I'd go with the S&P.
Investors, thank Will Rhind for joining us here on Masters of the Market. Definitely head over to GraniteShares, start to look at what investment vehicles they have for you. I have certainly been all over their site the past handful of days, and I am amazed, especially with the ability now to get a fixed rate, which is something I don't think I've actually ever heard before. But Will, I'd like to thank you personally for joining me on Masters of the Market. Definitely would love to have you back on at some point in time. And until the next time, investors, we will see you all there.